went bad. If your whole portfolio dies because one business goes bad, then that means that you didn't invest in the right way. That means you put your money, in a way where you didn't spread it out and not put all your eggs in one basket. So let me give an example of idiosyncratic versus systematic risk. Insurance companies. Insurance companies, they don't try to make all their money by insuring one person, right? What they do is they insure thousands of people, right? Why? Well, because if one person dies, another person lives. If one person gets sick, another person's healthy, right? So basically what they've done is they've washed away all the idiosyncrasies where they don't have to worry about what's happening with any one person. Then they've gone to a systematic sort of risk profile. So that means that if you are, let's say that you are a company that insures thousands of people, and the majority of the people you insure live, near Louisiana, and Hurricane Katrina comes through. Well, that's a big systematic event that's going to affect everybody who's invested in Louisiana. So you're probably going to lose money because something big happened. There's some big systematic event that has occurred that's causing you to lose money, or global warming, or maybe there's a bunch of earthquakes, or whatever it is, right? So those are big things that you can't control, almost like God risk, okay? So ultimately, with investing, that's how you categorize risk. And risk is very important. When risk goes up, when everything else is the same and risk goes up, then prices go down. So Donald Trump, for example, he tweeted something recently where he basically said, yeah, I've been negotiating with China, and the negotiations are going bad, and we probably won't end this trade war anytime soon. Well, at that point, stocks went boom, right? Stocks dropped because what happened then was that risk has gone up, that bad things are going to happen. Uncertainty has increased, so prices drop when there's additional uncertainty. So keep that in mind. And you've already known this. You already knew this actually when you were young. Think about this. Imagine if you you run a hair salon, right? And you've got two types of employees that you want to hire. Both of them equally good at doing hair. Both of them, highly skilled at what they do. But one person is consistent as clockwork. They're emotionally consistent, very professional, always show up on time, always do their job, no questions asked. And the other person is very erratic. They're up and down, up and down. Sometimes they show up, sometimes they get sick, sometimes they're nice, sometimes they're mean. They're kind of all over the place. Which person would you pay more? Which person would you invest in more? You'd invest in the consistent person more, right? Right? Why? Well, because naturally the value of that other asset has dropped in your head because you're thinking, I don't want to put that money on the line for somebody who might screw me, right? So what would have to occur for things to rebalance themselves is that each person, if you think of each person like a stock, this other stock, the risky stock, is going to have to lower its price to make you want to make that adjustment. So let's say that you've got the non-risky person and the risky person. You're not sure which one to hire, and you're worried about the risky person messing up your business. And let's say that the risky person says, come on, why can't I get as much money as so-and-so? And you say, well, because you don't show up on time, you don't do your job half the damn time, I'm worried about whether you're going to show up, blah, blah, blah. So what if they then say, okay, well, you're going to pay them $25 an hour, but you can pay me $9 an hour, right? Well, then you might say, oh, okay, well, since you said $9 an hour, then okay, I'll hire you over the other person, right? What happened? What changed? The price went down. The price of the stock dropped to the point where you hit what's called a new equilibrium. You hit a new point where you were like, okay, I'll invest in you now because now the price matches the risk level, right? That's exactly how stocks work. If you have two stocks, two companies identical in every way, one's low risk, one's high risk, the higher risk stock is going to have to drop in price until it hits an equilibrium point where investors say, okay, I'm willing to take on that extra risk because now you've given me a price that makes sense, right? So that's pretty much how you've always done things. You've always known these things your whole life. We just formalize them. When we teach investing, we just make it more formal, and so people get scared again. But it's really common sense. All this is formalized common sense. So what is risk tolerance? Well, risk tolerance is your ability to stomach risk. Some people some people don't mind risk at all. Some people hate it. But the thing about it is that as I saw in that as I proved to you in that example with the two hairstylists, there's a benefit, there's a reward for taking on the risky person, right? Because maybe you can pay them less, right? So there's some people who say, no. In our company, we need the best. We need professionals. We need people that are going to be consistent. So we'll pay for that. We'll pay them $30 an hour, even though the market price for a hairstylist is only $18 an hour, right? So you pay more so that you can get that consistency because you don't have a high risk tolerance. We don't have a lot of patience for nonsense. nonsense. But somebody who's struggling or somebody who wants to make a higher profit, if they can manage the risk, what they might do is they might go ahead and roll the dice. They'll say, look, we're going to go hire some people that can't get jobs at other places. Maybe they have a criminal record or whatever the case may be. And we're just going to find ways to try to manage the situation so that we minimize the risk, but we know we're taking more risk, but there's a reward for that. If we find that diamond in the rough, we find that $12 an hour person who's as good as a $30 an hour person, then we can make a big profit from that. So both decisions make sense, right? Like at the right prices, it makes sense to hire the low risk person. At the right price, it makes sense to hire the high risk person. The question is, what is your preference? What is your risk tolerance? And risk tolerance comes down to a lot of factors, right? Me as a boss, as the manager of the hair salon, my risk tolerance might come down to, how much money I have. If I don't have a lot of money, then I'm going to take on a lot more risk because I need to do that in order to afford to hire the people that I need to hire. It may come down to my personality. Maybe I have tools, risk management tools that will help to minimize the risk of hiring somebody with a record, right? So maybe I have, cameras in my hair salon. Maybe I have a manager that will call people in the morning to make sure that they do what they say they're going to do, or somebody to sort of help monitor the situation to make sure that things don't get out of control, right? So ultimately your risk tolerance comes down to how much risk you're willing to take, and it does make sense to take on risk, but it also makes sense to avoid it. It's a matter of figuring out what your preference is and how you want to invest. So a lot of times, so some of these other factors that are listed here that affect your risk tolerance are your investment horizon. How long do you have to invest? Those who have plenty of time can take on more risk because they can wait out the storms. Younger people that invest in the stock market can take on more risk than older people on average, because younger people can wait for the market to get better. Older people might already be 63 years old and they're retiring at 65. They ain't got time to sit around and waste. Your future commitments, what do you have going on that you're committed to financially that may cause you to not be able to remain invested for a long period of time? How many dependents do you have? If you have kids, people that have kids don't take on as much risk as people that don't have kids, right? You've known that naturally. You didn't have to take a finance class to understand that having children means you can't be out here just rolling the dice and taking chances, right? Your current commitments, what are your bills and what's your need for liquidity? Meaning how much, if your bills are really high, then it's hard for you to really invest at a high risk level because you may need that money on a short-term basis. So the list goes on and on and on. That's risk tolerance. I hope that makes sense. Mutual funds, indexing, and stock market volume. Mutual funds are great because mutual funds give you instant diversification. Mutual funds are like an economic soup. Mutual funds are where they take your money, they pull together with a bunch of other people, and they buy a bunch of different stocks with that big pile of money. And because you are one of the people that's pulled in there, you get a little piece of everything they invest in. A mutual fund is a lot like actually a company. Like if I invest in Apple, Apple's got 1,000 projects going on. When I buy my shares, I'm connected to all of that. And when those projects go well, my share price goes up. The difference with mutual funds is that the fund managers aren't actually running the company. They're not actually actively investing. They're passively investing. Well, scratch that. I don't want to use that terminology because I'm using it wrong. They are investing in a way where they are not the actual managers of these companies. They are shareholders in these companies, and they're holding shares on your behalf. So they are actively investing, but they're not actively involved in the investment. So if they buy shares of Apple Computer, they're not trying to go out and sell computers. They're just buying shares in different companies and shuffling stocks based on what they think the market's going to do. Indexing is a great way to invest as well because you can actually index and just tie your portfolio to some index. You can tie it to the S&P 500 and then set it and forget it. That's the best way to invest, in my opinion. Stock market volume is basically the amount of trade that occurs in the market. Markets that have a lot of volume tend to have certain characteristics that make them into better markets. They tend to have better what they call information flow, meaning that markets that just tend to have a lot of buying and selling, they tend to sort of operate in a way that provides a lot of advantages for an investor as opposed to a market that doesn't have a lot of buying and selling. Let me give you an example. Let's say that let's say that there's like a pawn shop down the street that has thousands of people go through this pawn shop every day, right? And it's a great marketplace where people are meeting every day and trades are happening all the time. That place is going to be pretty easy for me to go there and get a decent price for anything that I want to sell because there are all these buyers and sellers that are there. And so, if I have a diamond ring that's worth $1,000, and one person says, I'll take it for $400. Well, somebody else might say, oh, well, I'll take it for 600, right? You can get more, right? So that's a pretty good pawn shop. That's a good market, right? But then you can have, another pawn shop where there's only like 2 people a week that come through the pawn shop. And at that point, you're kind of desperate. You say, I got this $1,000 diamond ring. You want to buy it? And they say, well, I'll give you $50. And you're like, well, that's not, but this is this has gold encrusted and blah, 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 blah. I'll give you $50. And if you really need the money, you're going to take $50 because there's no other buyer there to compete with the other person. So trading market volume is an interesting thing. It's one of the things that makes a market good. Any market, actually dating is a market. Dating and relationships, finding a boyfriend or finding a girlfriend is a market. And most of us want to be in a market where there's a lot of volume. Like most women would, if you ask them, would you prefer to be looking for a boyfriend in a place where there's only 2 men, 3 squirrels and a puppy, or would you rather be in a place where there's like hundreds of men that all know about you, that are all checking you out and deciding if they're going to go come holler at you? Well, a lot of them would rather be in the place where the men are, right? Same thing for men. The guys go to, some of these guys go to these HBCUs where the women outnumber the men. So there's a lot of volume, which is kind of a weird kind of almost disgusting concept because the volume means that there's a lot of transactional activity occurring. There's a lot of sex happening, if you want to know what I'm talking about, right? Sex is a transaction. It's male and female get together and or I guess 2 men, 2 women. Y'all know, you know what I'm talking about. And they get together and they're trading. They're giving each other something, giving each other time. And there's lots of transaction. There's lots of activity. Let's just say that. And so I don't know if that's necessarily always a good thing, but it's actually a perfect analogy in the sense that you can imagine the good and the bad that can come out of that, right? When people are happier on one hand, but on the other hand, bad things can happen. Pregnancies, STDs, all kinds of stuff. So the same thing is true with a market that has high volume. You have the good side, which is, lots of people have, lots of other people that they can trade with. And when there's more trade, there's more utility. Everybody's happier when there's trade. Or you can have the bad side. You have more financial STDs. You have more financial problems, people robbing each other, bad things happening. So that's why you also need regulation in a market with high volume. So the reason that the U.S. market has a higher per capita value than most markets around the world is because they have lots of volume and lots of regulation. So it means that there's lots of people trading and there's lots of financial police like the Securities and Exchange Commission and FINRA to say, hey, if anybody hurts you, you let us know and we're going to go take them down. And we're going to take them down hard. We're going to take them down publicly so that everybody knows that if you want to come to this club, if you want to trade in this club called the New York Stock Exchange, you better come correct and you better act right or you will go to prison. That's why Ephraim Taylor, I don't know if anybody remembers Ephraim Taylor. Ephraim Taylor was a young brother that was going from church to church, raising money for his investment company. And the feds determined that it was a Ponzi scheme and that he wasn't really investing the money. He was violating federal law. And they put Ephraim in prison. I think he got 19 years in prison. And that made me really sad because Ephraim was a very smart young man. I didn't know him, but I knew people that knew of him because a lot of people talked about how smart he was. And I just think maybe there's a possibility that he got carried away or didn't follow the fine print or didn't know the severity of violating federal law when it comes to stock trading. But do not mess with the Securities and Exchange Commission because they will take away your entire future just to make an example out of you. Be very careful with that. Moving on. All right, so value stocks versus growth stocks. Value stocks are what Warren Buffett loves. Value stocks are basically stocks that in which the intrinsic true value of the stock is far lower than the market value. And and the thing about value stocks is that it's really, really hard to figure out the true intrinsic value of the stock. Theoretically, the market value and the intrinsic value should be the same. That's theoretically what's supposed to be true. But in reality, that may not be the case. What's an example? Imagine going to the mall and somebody says, oh, here's a $300 pair of jeans for $80. That is the equivalent of a value stock. That's like, oh my God, it's $80, but it's worth $300. That's awesome, right? So that's what a value stock represents. Now, the downside of that, though, is that somebody else can come along and say, no, that's not really a $300 pair of jeans. Look right here. Do you see the little rip in the jeans? Like the little rip here. This is where the inseam was done wrong. That's why they're charging you $80. So then you suddenly realize, oh, I thought I was getting a bargain, but really I'm not. Really, this pair of jeans is only worth $80 because they can't sell it for $300, right? So a lot of times there's controversy about which stocks really are value stocks versus which ones kind of look like value stocks. Like sometimes, stocks will drop in price and people will say, "Oh my God, what a bargain! This $10 billion company is on sale for $8 billion," and people will assume that there's an opportunity when the reality is that in many cases there's something fundamental that shifted about the company where the company's not worth $10 billion. You're not getting the $300 pair of jeans. You're getting an $80 pair of jeans. You're getting a company that's worth less than what it is. So an example with dating is, have you ever had a situation, tell me if you've ever gone through this, where you met somebody and they were so perfect that you were like, this is too good to be true. Oh my God, I am the luckiest son of a bitch on the planet because I just met the most attractive person in the world and they just happen to be single and nobody scooped up this person. Oh my God, oh my God, oh my God, right? Well, that happens. That's happened to all of us at some point, right? But then somebody else might come along and say, actually, there's a reason this person is single. The reason they're single is because there's something wrong with him. Like, he's crazy, right? Or she tried to murder her ex-boyfriend, right? So ultimately, what you end up seeing is a situation where even when people think that they've spotted a value stock, they haven't always spotted a value stock. People like Warren Buffett, who read books like Graham and Dodd, by Graham and Dodd, called Value Investing, that's what they believe they have the ability to do. They believe they have the inherent ability to look at a stock and determine if the real value of the company is different from the market value. And Buffett's done that reasonably well. And there's some evidence to say that there are some simple procedures you can follow. Like, for example, people that invest during market downturns when there's market panic, they tend to believe that there are lots of undervalued stocks out there. That there are stocks out there that that are just on sale, that are cheap, and they're really worth more than what than what they're trading for, and they buy. Or so, for example, you might look at a city like Detroit, where you've got a house that used to cost $100,000, now it's on sale for $40,000. That would be the example of a value investment, right? Where you're buying it for less than what it's worth. Now, growth stocks, on the other hand, just so you guys know, I saw one of you asked a question about this. If you want to see more of this material and more detailed analysis and things like that on anything, just go log in at drboycemasterclass.com. That's drboycemasterclass.com. When you log in, you've got recordings of all the masterclass sessions. You've also, if you want to, hang out long term, you can go to theblackstockmarketprogram.com, theblackstockmarketprogram.com, and use the code word Powernomics, and you can get 50% off. Okay, so growth stocks are basically companies that are what they call the high flyers.